Don't fall for these 7 investment traps. Protect your wealth. Investing money is an excellent way to increase your wealth, especially in the long term. But if you are new to investing, it is easy to fall victim to certain pitfalls that could set you back financially. There are 2 types of investment traps, namely cognitive and emotional, but they are generally defined as behavioral biases. A bias is mostly an unconscious predisposition to think or behave in a certain way in a given situation. It is easy for investors to get trapped by them because investing always involves incomplete information and a range of probabilities. There are many aspects of investing that are out of our control. Sure, we can hope for a certain outcome, but it can never be guaranteed. So biases are simply the shortcuts we use to make investment decisions. Therefore, in this text, we will examine some of the traps you should be aware of and avoid. 1. Anchoring trap. Anchoring refers to an over-reliance on what was originally thought. It involves attachment to the idea of the initial value of an asset to such an extent that it leads a person to make wrong decisions. For example, you might have the impression that a certain company is successful and think that buying shares in it is a good path to take. However, this concept might be inaccurate at the moment or in the future. The same happens when an investor holds onto a stock for too long because they are anchored to the higher price compared to what it was bought for, when in reality it should have been sold long ago. To avoid this trap, you need to have an open mind and be receptive to new sources of information and understand that just because a company is doing great today does not necessarily mean it will still be at the top tomorrow. Studies have shown that some factors can mitigate anchoring, but it is difficult to avoid it entirely, even when people are aware of the bias and deliberately try to avoid it. But in any case, keep in mind that the future performance of an investment is never guaranteed. Just because a stock did well last time does not mean the same will happen next time. Do some research and discover the price history of the asset to help you understand how it is likely to behave in the future. Be open to new information about investments, even if it may not perfectly reflect what you initially learned about the stock. 2. Sunk cost trap. This involves protecting decisions or choices you made in the past, which is often harmful to your investments. This is caused by not truly accepting that you made the wrong choice that led to losses. It can also be said that it is a person's tendency to complete something that does not meet their expectations, primarily because they have already invested time or money. This explains why people tend to keep clothes they rarely wear, finish meals that do not taste good, and watch movies they do not like to the end. And also why they cling to underperforming investments. This is similar to anchoring and involves individuals holding onto stocks in the hope that the price will return to where it was initially. In this case, the investor is protecting their decision to buy and hold that particular stock, which can negatively impact their portfolio. If your investment is not doing well or is sinking rapidly, the best advice would be to abandon ship as soon as possible and look for something more promising. As difficult as it may be, you must accept the loss or the fact that you made a wrong decision. If your investment is not going as expected, move on before the price of the asset drops further. A piece of advice: avoid any emotional attachment to your investments to make it easier to let go before things get worse. The best way to avoid this trap is to set investment goals. Investors could set performance goals for their portfolios, and if these goals fail, they could be re-evaluated to see where improvements can be made to achieve better returns. 3. Pseudo-certainty trap. The term, also known as loss aversion, describes an investor's view on risk. When investors think their investment returns will be positive, they limit their exposure to risk. However, when they are heading towards a loss, they take on more risk. They are willing to increase the stakes to reclaim capital, but not to create more. Loss aversion can be involved when the thought of losing money overshadows any potential money gain with an investment. It usually occurs when an investor is unwilling to take risks to avoid losses. Obviously, there is always risk in investments, and some are riskier than others. When loss aversion sets in, you lose potential profit because you fear losing the investment capital. There is no doubt that taking too many risks is a recipe for disaster, but so is not taking enough. Develop a solid investment strategy and do not let your emotions influence your decisions. Allow yourself some discomfort. Make thoughtful decisions about where to invest by choosing assets that have a good track record. 4. Superiority Trap, also known as the overconfidence trap. Many investors are too sure of themselves and think they know more than the experts themselves and even the market. Being well educated does not mean you cannot benefit from some advice here and there. Many investors have lost enormous amounts of money thinking they are better than everyone else, and these are mostly the same people who fall into a series of the above-mentioned investment traps. Investors trapped in the superiority mindset have an exaggerated view of themselves. They are excessively confident in their investments and abilities, and as a result, they might even reject good advice that could lead to errors in their judgment. An investor might become reckless and fall into a losing position, supported by the assumption of knowing more than the market. The investor is optimistic that the market will eventually see the value proposition of the stock and push it higher. But if the stock continues to fall, the investor chooses to cut their losses and close the position. If you are excessively confident in the investments you are making, you might fail to implement the necessary safety measures to protect your investment capital. You might actually make wrong decisions and end up risking too much, which can only cause losses. 5. FOMO stands for fear of missing out, which is closely related to herd behavior, as it drives people to follow what others are doing without thinking. Herd mentality refers to the tendency of an individual, in this case investors, to follow and copy what other investors are doing. They are widely influenced by instinct and emotion rather than their independent analysis. Investors follow other investors probably because they see them being successful rather than making their own informed decisions about where they would like to invest. Investors who fall into this trap usually fear missing out on a potentially profitable investment when they see their friends or someone close to them investing heavily in it. So, instead of feeling left out, they feel much better and more comfortable when they follow the crowd. Many dot-com companies, for example, did not really have financially sound business models, but many investors joined them just because other people were joining. Following the crowd seems to be a way investors think they are making the right decisions. So, if everyone is exiting the market, they feel safe doing the same, rather than being the only ones left behind. Do not rush to do what others are doing without first doing your research. Carefully evaluate the investment and analyze the company's fundamentals before deciding whether it is worth investing in or not. 6. Irrational exuberance trap. Irrational exuberance, also known as the overconfidence bias, is a tendency to hold a false and misleading evaluation of our abilities and intellect. In short, it is the belief that we are better than we actually are. While confidence is considered a strength in many scenarios, when it comes to investing, it is more of a weakness. Investors tend to think that the past is equal to the future, as if there is no uncertainty in the market. What happened before will surely happen again. There will always be ups and downs, something that will turn the fortunes of investments that were once at the top. It often happens that investors' overconfidence turns into greed and pumps the market to a point where a huge correction is inevitable. And those who are strongly affected are those who went all in just before everything went wrong, those too confident that the well will never run dry. If you are new to the world of investing, consider working with someone experienced who can develop a solid investment strategy that can maximize profits while avoiding too many risks. You do not have to rely only on yourself, as there are many experts who can help you along the way. 7. Confirmation trap. A confirmation trap occurs when people seek and take note of other investors or assets that confirm their current beliefs. It can also occur when investors continue to receive advice from others who have made and continue to make the same mistakes. Sometimes people seek advice from these individuals, hoping to make the right decision this time. Instead of listening to someone who has given you bad advice, turn to fresh sources that will give you sensible advice on potential places to invest. When researching an investment, investors might inadvertently seek or favor information that supports their preconceived ideas about the asset or strategy and not recognize information that contradicts their ideas. This creates a one-sided view and leads investors to make wrong decisions. Confirmation bias is a source of overconfidence on the part of the investor and helps explain why they do not always act rationally and perhaps supports the arguments that the market behaves inefficiently. The first step to overcoming confirmation bias would be knowing that it exists. After gathering information that supports their beliefs and opinions, they should seek alternative viewpoints that challenge their perception. In short, have an open mind. It is true that investing involves risks, but you might be even more vulnerable if you find yourself trapped in one of these investment traps. Do your research in advance and find out what works for you. Follow some of these tips and save yourself not only time but also money. In the comments, share your direct experience related to the topic covered today. We want to learn more and will gladly respond to any questions. Comment to let us know how we can improve. Your like would make us happy. Do not forget to subscribe to the channel so you don't miss the next video.